Silver has been extracted and consumed for thousands of years. But here's the question on every investor's mind. How much is left, and how soon could it run out? The numbers are shocking. At current mining rates, proven silver reserves could be gone in less than 5 years. Even broader resources may last only until the 2030s. And that's before factoring in rising demand from technology, solar panels, and investment. If physical silver becomes scarce, the paper-silver system, which today stands at a 400-to-1 ratio, could unravel. And when that happens, silver's price won't just rise. It could multiply. Why physical silver matters more than ever. Unlike gold, silver is not just a monetary metal, it is an industrial necessity. It's used in electronics, medicine, energy, and especially solar panels. Once consumed, much of it is lost forever in landfills and products that will never be recycled. That means silver is not like gold, which mostly sits in vaults. Every year, silver disappears from the system. And the less there is, the more powerful the price impact will be. The numbers behind silver supply, let's look at the raw data, all in metric tons. Total mined historically, 100,000. Remaining total silver, 770,000. Proven reserves, 108,000. Resources including reserves, 340,000. Mining production per year, 26,000. Recycling per year, 5,500. Total annual supply, 31,000. These are the starting points for our depletion scenarios. And the results may surprise you. What the math tells us. Depletion dates. Scenario: reserves only, flat production, 8,000, 26,000, 4.15 years. Reserves run out around late 2029. Scenario B: resources including reserves, flat production, 1,000, 26,000, 13.1 years. Exhaustion by mid-2038. Scenario C: resources with 2% annual mining growth, exhaustion in 11.8 years. Spring 2037. Scenario D: resources with 5% annual mining growth, exhaustion in 10.3 years, late 2035. Scenario E: remaining total 770,000 at today's total production, 770,000, 31,000, 24.8 years, summer 2050. The takeaway: depending on definitions and growth rates, silver supply could run tight anywhere between 2030 and 2050. Investor psychology and the coming silver squeeze. Markets are driven by psychology. In silver, short-term traders see stability and get bored. Weak hands sell, thinking nothing is happening. Meanwhile, big players accumulate quietly. When a breakout finally arrives, whether triggered by supply shock or loss of faith in paper silver, it tends to be violent. Short sellers rush to cover. Retail investors scramble to get in. Momentum accelerates. And because silver is a relatively small market compared to gold, the squeeze can be explosive. Paper versus physical. Why the 400-1-1 ratio won't last. Today, for every 1 ounce of physical silver available, there are about 400 ounces of paper claims, futures contracts, ETFs, and bank promises. As long as people trust paper silver, this ratio can survive. But the moment investors demand delivery or governments restrict trading to physical-only markets, the system breaks. Imagine a world where silver can only be bought and sold physically. Overnight, the 400-1 ratio collapses. And the price? It could jump hundreds of times higher. What happens if that ratio collapses? Let's play with the numbers. If 401 falls to 201, silver price could double. If it falls to 100.1, silver price could quadruple. If it falls to 11, silver price could rise by a theoretical 400 times. Even if the most extreme case never happens, the direction is clear. As physical silver gets scarcer, paper claims become less credible. And the closer those claims come to reality, the higher the price must go. Historical parallels history shows what happens when silver and gold markets tighten. In the 1970s, after the US abandoned the gold standard, silver exploded from around $1.50 to nearly $50. In 2008, amid the financial crisis, silver surged from under $10 to nearly $50 again in just 3 years. Each time, shortages and distrust in paper markets magnified the rally. What we're seeing today, tight supply, rising industrial demand, and distrust of financial systems, looks very similar. Central banks and investors shifting from bonds to metals. For decades, central banks stored wealth in US Treasuries. But with US debt now above $37 trillion and interest costs exploding, trust is fading. Many nations are reducing treasury holdings and building reserves in gold and silver instead. Private investors are doing the same. Every shift away from bonds and toward metals adds fuel to the fire. The decline of treasuries and the dollar treasuries were once considered risk-free. Not anymore. Rising debt, political dysfunction, and endless deficits are eroding confidence. At the same time, the dollar's dominance as the global reserve currency is slipping. BRICS nations are trading more in yuan, rubles, and even directly in gold. When trust in treasuries and the dollar declines, trust shifts to hard assets. Silver, as both industrial necessity and monetary metal, is perfectly positioned to benefit. Silver is the ultimate insurance. Silver isn't just an investment, it's insurance. You don't buy fire insurance because you expect your house to burn down tomorrow. You buy it because the risk exists. Likewise, investors and even nations buy silver not because they expect collapse today, but because they know the system is fragile. Physical silver cannot be defaulted on, frozen, or printed. It has no counterparty risk. In a world of uncertainty, that makes it priceless. What this means for investors, here's the bottom line. Silver reserves could be gone by 2029. Broader resources may last into the 2030s or 2040s, but demand is rising fast. The paper-to-physical ratio of 400:1 is unsustainable. Even a small adjustment could double or quadruple prices. Central banks and investors are quietly shifting from debt to metals. Ignoring silver in this environment is reckless. Even a modest allocation can protect wealth in times of chaos. Silver may look stable today, but the numbers show it's building energy for an explosive move. Proven reserves are thin. Industrial consumption is rising. Paper silver is fragile. Governments and investors are pivoting toward metals. When the breakout comes, it could be historic. Silver isn't standing still, it's preparing. And those who recognize this before the crowd could see life-changing gains. If this helped you see things differently, drop a comment. We'll answer your questions. Subscribe for more honest finance content, and remember, smart money doesn't sit. It moves.